at Nuvama Group is joining in. Prateek, great to have you with us on the show. Thanks for joining in. Tough times for the market so far in 2023, right? It's been all over the place. This whole specter with inflation and interest rates, that continues to be the dominating talking point. So you tell us, what have you made of the very range-bound to basically negative bias that we've been in the midst of? Do you see this continuing?
Yeah, hi. Thanks for having me over. So I think clearly 2023 has started on a very different note compared to 2022. If you look at 2022, it was a very unique year. Globally, there was massive turmoil and chaos. There was hardly any asset class which, there was a place to hide. Almost all asset classes yielded negative returns. But yet, despite that, in India, while headline index was flat, I think what was very encouraging was that you had some of the high beta sectors or some of the cyclical sectors on the domestic part of it doing very well. For example, PSU Bank and capital groups. So as a result, while there was global turmoil and global chaos, in the overall markets, while they were range bound, the bias was more on the bullish side per se. But in 2023, I think the outlook is changing. And there are a couple of reasons for the same. First, I think fundamentally what is happening is that last year we saw a lot of global slowdown where exports contracted. I think this year, the result season that has gone by so far, we are now seeing some signs of slowdown on the domestic side as well. Especially domestic consumption, which has so far been resilient, is showing some signs of crack. The sales slowdown that we've seen in some of the durable companies, some of the QSR companies, is quite meaningful. And as a result, this year around, there are more concerns on the domestic part compared to the global part. Second, last year, while there was global liquidity tightening, on the domestic part of it, you had liquidity being largely in surplus and rates were still very benign. Now, even rates are catching up. So to that extent, I think clearly 2023, the outlook is a lot different from 2022. And in 2023, I think from inflation and liquidity, I think we are more worried about the growth part of it, where on a cyclical basis, the domestic growth as well, could see some moderation after it being very strong last year per se. Is what I feel.
I think,
and to that
yes,
cautious that's warranted.
I think, Prateek, that, growth scare is understandable. We were just talking a while back about the minutes of the MPC meeting, right? The RBI MPC meeting. And that indicates that the entire committee believes that it's premature to pause on rate hikes in India. Now, if rate hikes continue here, then once again that argument comes up about how much it could hit demand. Inflation in any case is pinching pockets. So what happens to that whole consumption piece? As an investor, do you keep away? Do you buy the dip? What's the strategy? Not just FMCG, I'm talking about, automobiles, even the luxury end, which is doing well now, but will it also get hit as rates go higher?
Yeah. So our strategy towards consumption basket is, Sonia, that, we break down sectors into two buckets. One is sectors which are sensitive to top line or demand outlook per se, where earnings, valuations, are shaped more by demand. And then sectors which are shaped more by margins or input prices of sorts per se. Now, within the consumption space, I think the sectors which are sensitive to demand, I think is where caution is warranted. The whole durables pack, real estate, I think this is a space where we are a lot more cautious because we think that the demand slowdown can be quite meaningful. These sectors are coming off a very large base as well that happened post-COVID. And with RBI still maintaining or continuing on the rate hike path, we think demand will be challenging. Valuations over here are still not yet very attractive, despite the stock correction that we have seen. So that's a space that we'll be cautious on. But nonetheless, where we do see opportunities is, I guess, on the FMCG space, where we think margins, which was a big headwind, are clearly receding. Where we should see better improvement on the margin outlook over there. And here, given the underperformance post-COVID, we still feel that this is a space to be worth looking at going ahead, especially given the fact that even on rural, we are seeing some green shoots of sorts per se. And the other space that we're more constructive on the consumption pack is the auto. And the simple reason is that post-COVID, this has perhaps been the most laggard in terms of recovery. So there is still scope for